Hello, hello, hello. What's going on, everybody? Good morning, good evening, good night, depending where you are in the world. Hopefully everybody can hear me now loud and clear, and you can also see the screen, just an empty gold chart in front of you. Welcome to the Capital Hungry Monday Market Update webinar. Through this webinar, we will be taking our time to do some analysis, both fundamentally and technically, across understanding of what fundamentals are impacting the market, economic events, market sentiment, and some intraday and scalp trade ideas on gold, GJ, GBPUSD, EURUSD, USDCAD, and US 30 stock market index. Let's not waste any time here, and let's jump straight into the meat and potatoes. So, some recent key fundamental points that we have to focus on is, of course, understanding the market timing. For those of you who are unaware, we've just ended the first quarter of this new year, 2022, and are transitioning into the start of Q2. So as you can see, for the first start of this fresh month and quarter, volume and volatility is relatively lower and slower. Some other key fundamental points was also last week, where the Bank of Japan announced an unlimited bond buying program at a specific price, which led to some further weakness in the Japanese yen individually, as the Japanese yen hit 2008 historical lows and USDJPY is starting to hit historical highs. Also, a lot of the fear, uncertainty, and doubt via the Russia tensions have been priced into the markets, and we do not have any new fear-related events. Okay, so you can also understand that with not having any new fear-related events in the market, that markets have been relatively optimistic. Global equities are still very bullish across the board as the greed train continues to extend by the stock market whales, market makers, whatever you like to call it. With those fundamentals in play, you can see it's having an impact on both the volume and volatility and market sentiment. When we're analyzing market sentiment, you can see that individually, when we look at the US dollar, it's still very bullish, as the Federal Reserve has been transitioning into rate hike territory, and at the same time, the fear, uncertainty, and doubt tensions we had previously kept dollar alive as a safe haven currency and as the world reserve currency. And we'll be showing some individual analysis on that after. As stated earlier, because of Bank of Japan's monetary policy sentiment and how they are still increasing their bond purchases, the Japanese yen individually is very bearish. But if you understand how Japan's debt and economic structure is set up, this is actually favorable for their macroeconomic activity. As per Bank of Japan representatives, having a weaker Japanese yen promotes more economic activity with their international business in import and export, which is one of their major revenue sources. So yeah, it sucks for the Japanese individual that their buying power of their currency is going down, but for the economy as a whole from a macro standpoint, Bank of Japan and the Japanese government doesn't mind devaluing the yen in the short term. So we've been playing that weakness on the Japanese yen. Global equities are still very bullish across the board, as we priced in the fear, uncertainty, and doubt events from Russia and Ukraine, as the interest rates were priced in from Fed 25 basis point hike. We can see the dip on equity markets across the board were bought up, and we've had some continued upside after that short-term correction, which I'll be showing you shortly. Now, as we are of course just starting out the new month and new quarter, and as you may have noticed how we were trending on various asset classes through the start of the new week and through New York session, volume and volatility isn't the highest right now. We're seeing a lot more intraday ranging on pairs. We're not seeing any real clear upside or downside trending markets, as we're just getting the price set up for the new quarterly period. So as we are manual retail traders who are more than likely scalping or day trading, you have to adapt to the market volume and volatility accordingly. When we don't have as many fundamental catalysts as play, when we don't have as aggressive volume and order flow within the market, you want to be able to adapt to that, take your jabs at the market, and live to trade another day. Something else we have noticed is just some key headlines, of course, through the New York session. One, we're still seeing headlines with NATO regions, of course, condemning what's going on with Russia, but a lot of this is just noise. But one thing we have to do is still continue to watch as these events unfold. If we get any new events for market makers, smart money to price in. But some of the headlines since the morning was UK Prime Minister Johnson, Bojo, says his spokesman, says the PM will do everything possible to provide the military aid Ukraine needs. Kremlin condemns comments by leader of Poland, ruling party, saying Warsaw wouldn't be open to having US nuclear weapons on its soil. So that's obviously Russia showing some disdain towards Poland, as Poland is showing potential help towards NATO and US allies. Then another interesting headline, just for a lot of the crypto heads and people involved in crypto, is the SEC of the US would aim to ensure investors are protected when trading crypto as they would be on other exchanges and platforms. So they want to bring the same type of protection to the crypto markets, but this would also mean a lot more regulations coming into play, just like any other markets like the stocks, commodities, currencies, and so forth. So something to keep an eye out there if you are in crypto trader. Now, when we're looking at market sentiment, you can see what I'm talking here across the board when we're looking at our global stock markets. Over the last couple of months, as we had interest rates going up, and of course, fear, uncertainty, and doubt regarding the Russia tensions, this led to profit taking on global equity markets from all-time highs and deeper pullback plays as buyers liquidated positions and short orders entered the market in that short-term period. This led to dips on equity markets across the board, but of course was very short-lived, as stock market buyers do not want to get rid of this greed train. It instead ended up creating that technical dip. A lot of the fear, uncertainty events with Russia got priced in, and the market sentiment of optimism came back into play, with stock market buyers buying up those dips from more favorable demanded price points. The interest rate decisions being priced in, inflation still being high, and of course a lot of the fear, uncertainty, and doubt being priced in and digested by investors is keeping stock markets across the board relatively bullish for the time being. That shows us that investor and smart money confidence is still relatively high within these global regions, and that greed train isn't stopping anytime soon. So we still look to play some of that market optimism. We can also see this further highlighted with the Japanese yen as a safe haven currency, individually bearish in structure, and this price point of interest being 2008 historical lows. The Volatility Index, which is a fear and greed indicator of the US equity markets, inverse information of the S&P 500 order flow. This is extremely bearish, showing markets are optimistic. The only difference is the US dollar, which is the world reserve currency, has been more bullish on the higher time frames, just in this consolidation zone, sitting at these intraday highs. So when we're looking at our currency pairs, I'm still looking to play Japanese yen weakness, even if we got a bit of a double top, expecting us to drive down into these previous lows and deeper lows. I'm still looking to play the Volatility Index weakness, but on our dollar pairs, I'm still bullish on our dollar. Now, when we're looking at the US dollar individual movement, you can see we're in a correction phase sitting at highs. A correction phase can usually come as two things that we identify as manual retail traders. One being a consolidation zone, order block, range, whatever verbiage you like to use, whatever makes you help understand it easier. Or two being a potential pullback phase, right? So usually one of two things will happen in a corrective phase. You either have order generation and collection in a consolidation zone or order block, or as you have highs printed by buyers, you have buyers take profit and liquidate positions out of the market. Sellers jump in hand to relieve them out of the market, and this creates a pullback to a more favorable demand zone before having buyers jump back in the market and continuing back up. Even though I am bullish on the US dollar, for us to see continued dollar strength from a technical perspective, we would need to be breaking above these technical high price points at 99.2. A break above 99.2 on the US dollar would signal a lot more upside pressure and expectations of buyer volume entering the market for us to extend into higher highs, playing that continued structure. So, again, when we're looking at the market sentiment, I am still looking to play some strength in the US dollar on GBPUSD, EURUSD, potentially USDCAD. I'm looking to play some weakness in the Japanese yen for those individual fundamental reasons stated. Remember, fear, uncertainty, and doubt priced in, lower volume and volatility for the start of Q2. Bank of Japan unlimited bond buying program is keeping the Japanese yen weak. And I can show you guys a headline, but I don't have the newsroom up right now. There was actually a headline from Bank of Japan representatives that they wouldn't even look to do any currency intervention or interest rate hikes unless USDJPY hit the price of 130 flat. If UJ hits 130 flat, then that's a bit too weak on the Japanese yen individually. Then the Bank of Japan would look at interest rate hikes to start to bring the value back up. But if you look at the price of UJ, we're still like 800 pips away from 130. You know what I mean? So that market sentiment understanding, dollars ranging, but we're on the bullish side. Japanese yen, even though it had a bit of a cap bounce from the 2008 historical lows, very bearish. Volatility index, bearish. Equity markets, bullish. Okay? Now, let's take a look at gold. Gold on the higher time frames here is extremely bullish. But one thing we have to understand is we've had very large impulsive moves in the market. And when you look at how a beast like gold behaves, let me show you guys a bit of technical repetition. So we understand that the market moves in waves. You of course have transactions and orders enter the market. Those various investors, smart money, market makers, whatever you want to call them, liquidate positions out of the market. This is what creates these market waves of higher highs being printed, aggressive pullbacks, and so forth, right? The last time we had very significant upside moves, buyers liquidate positions in a pretty aggressive equal side correction. You can see for an extended period of time, we start to range at a demand zone before seeing enough buyer order flow and extending up higher. You can see a similar situation here where we start to range at a demand zone before having enough buyer order flow in the market before extending higher. Now, when the Russia tensions were first coming at a peak and we had economic sanctions going off, a lot of fear, uncertainty, and doubt, we had equity markets dropping down, where that outflow in the equity markets saw an inflow in gold to hedge against the fear risk. We had a huge impulsive move on gold, where you have to understand this price point of interest, 2075, 2080s almost, is the all-time highs that was peaked on a surgical dime from the pandemic, right? So we didn't go to some random price point of interest. We went to a surgical previous high on the higher time frames, then saw buyers liquidate positions. And I want to show you something very interesting, okay? Everybody pay attention right now, okay? Listen, look at how the smart money market maker whale order flow moves through the market. Look at the higher time frames here on US 30. The same time we saw institutional order flow exit out of the equity markets and buyers liquidate positions during the fear, uncertainty, and doubt, is the same time we saw gold explode to those all-time previous highs. Listen, the stock market buyers take their money out of the stock market, liquidate positions at the highs, take that capital and dump it into gold as a risk against as a hedge against the risk of uncertainty. Then gold explodes from the 1800s to 2080. They take their stock market money, make a huge profit on the explosion in gold, and then as gold hits 2075, they take their profit out of gold, liquidate those positions, and jump back in the stock market from the dip. Crazy, right? Does that make sense for everybody? This is how the order flow moves based on market sentiment, how you're seeing the changes in order flow from a global perspective. And you might be asking, well, US 30 only dropped a bit. Why did gold go up so aggressively? Well, it's not just the equity markets that saw downside in the US. It was global equity markets that did a dip. So you saw global stock market investors exit out of the equity markets, take that profit out of the equity markets, dump it into gold, make money in gold during the fear from 1800 all the way up to 2075, take that money and profit out of gold, dump it back into the global stock markets from the dips, and now they're riding this wave back on the equity markets with high inflation, fear priced in, and so forth. Right? Very, very interesting how you see the order flow move across the board. Now, what we can see is, even though gold had this very aggressive pullback, it didn't break higher time frame market structure. We ended up coming down very similar to this situation here, right? And very similar to this situation here, where you have a demand zone being respected at the lows. You can also see after the impulsive moves, you consolidate both before and after for an extended period of time. Now, as global inflation is still high, as we still have potential new fear, uncertainty, and doubt that can come in the markets, even though we may get some short-term downside, gold technically is still bullish above the 1880s buyer's demand zone. You can see even with the aggressive pullback, we came to this demand zone, bounce with the candle bodies. We even saw the exact same bounce here from 1880s again, and a flat candle body support being created. This piece of market structure here, circled in white, and what we're seeing happening is very similar to what we saw happen here. As long as we don't break these lows from a technical perspective, gold on the higher time frame is still bullish, with the potential to drive back into the 2000s and 2020s. Especially as we're starting out the new quarter right now, and over the next week or two, I do expect fear, uncertainty, and doubt escalations to continue and come back into the market. So with gold, right now, we're still playing some of the higher time frame bulls, and we're still playing some potential bounces from this range. So what I would see in terms of trade ideas on gold is 1923 buys, breaks above 1939 buys, breaks above 1945. Don't forget, gold is in a higher time frame range right now, and we're just in that consolidation phase as we're starting out the new quarter. I would only look for gold sells below 1912, where that would be some short-lived sells to set up better buys at 1890s. Okay? Green boxes being buy areas and buy pathways of price, I would only technically sell gold below 1912, expecting us to come down into 1890s for a potential buy bounce there. Okay? Otherwise, with inflation still being high, interest rates being priced in and well known, overall market structure still bullish on the higher time frames, I'm still expecting that upside. Any downside would be short-lived to set up better buys, as I still see very similar technical repetition and fundamental repetition to these scenarios here. This scenario here, I'll show you guys exactly. Upside move, buyers take profit, don't break the demand zone, consolidate for an extended period of weeks, still overall start to make your way back to the highs, right? Here, a smaller version, upside move, buyers take profit, you consolidated there for a period of days, right? You don't break that very key demand zone, and then you continue back up to the high points, right? Here, yeah, there's many situations where gold and stock markets can be both bullish simultaneously because of individual fundamental factors. For example, inflation keeps both the stock market bullish, gold bullish, commodities bullish across the board if inflation's very high. Same situation here, upside move, correlated pullback in relation to the upside move. Don't break the demand zone. You start to consolidate for a period of days and weeks, but as long as you don't break that demand zone, you do see some upside back to the highs. Okay? So again, you can always rewind this for those exact trade ideas of interest. The only thing we have to keep an eye out, and I forgot to talk about, is some of the economic data we have on the docket. But we don't have too much US economic data until later in the New York session, 9:45. But let me go over that now. I forgot to go over what economic data we have. So, this is what's on the docket for tonight and tomorrow. Japan PMI figures, 8:30. Midnight, Reserve Bank of Australia cash rate. 2:45 a.m. Eastern, industrial output France. 3:15 a.m. Eastern, services PMI Spain. 3:45 a.m. Eastern, PMI Italy. 3:50 a.m. Eastern, PMI France. 3:55 a.m. Eastern, PMI Germany. All of this impacts Eurozone. Okay? Then 4 a.m. Eastern, PMI Euro. All of these PMI figures are expected to drop from previous, potentially bringing some Euro weakness, which would make sense on EURUSD sells with expectations of dollar strength. 4:30 a.m. Eastern, UK PMI figures. 8:30 a.m. Eastern, US international trade balance. 8:30 a.m. Eastern, also CAD international trade balance. 9:45 a.m. Eastern and 10. This is most importantly, this is what's most important on gold and dollar pairs is US PMI and non-manufacturing PMI. Okay. Now, GJ. GJ with the individual weakness in bearish Japanese yen, UK equities holding strength at all-time highs, GJ is extremely bearish on the higher time frames. But we have a very similar idea in terms of market structure as gold. When we're looking at the higher time frames, you can see GJ last week on the Bank of Japan headline that was talked about here. Sorry, in the fundamental points, the Bank of Japan headline from last week, that led to impulsive weakness on the yen and a huge upside play on the weekly here that went to this price sensitivity area to the left, where you can see all this price sensitivity and noise right on the dot, right? Higher time frames still extremely bullish, breaking above previous highs, price action extremely bullish, Japanese yen individually weak, UK equity markets hot, right? Similar idea. We had buyers extend from this demand zone, buy orders collected from this price sensitivity area, and an impulsive upside move. As we had that impulsive upside move to that weekly price sensitivity area showed you guys to the left, we have buyers liquidate positions, take that money out of the market, sellers jump in hand to relieve them out, this creates a pullback phase that's in correlation to the impulsive move. We come down to the same demand zone, create a double bottom, and still holding higher time frame bulls, where even if we got deeper pullbacks, our expectations are to drive back up to these highs, right? As we teach market structure, I'm just going to black out the screen for a second, everybody. This is how it works. When you're looking at an asset class that is extending up in value, and you're looking at the technical waves printed, because you have market participants and so many market participants from an institutional perspective across all time frames, you have algorithmic trading going on and transactions going on in minutes, seconds, hours, days, across the clock, right? So if you see an asset class that smart money is interested in from a low price point, whether it's an intraday low, scalper low, a daily low, a higher time frame low, you'll see orders flood the market. This volume of buy orders flooding the market will increase the value of that asset class, pushing it up to a favorable seller's price point for them to liquidate and short orders to come in for them to relieve out of the market. When there's a significant change in price, you have the institutional market makers exit out of the market, sellers jump in, that creates a pullback phase. A combination of pullback phases or consolidation zones is what prints your bullish market structure. Right? That's how you generally analyze market structure, with various consolidation phases in order collection, highs being printed, pullback phases, and so forth. This is all we're seeing when we're looking at GJ from these 149 demand zone low points, and especially as a lot of the fear, uncertainty, and doubt has been priced into the markets. So GJ is still too bullish for me above this demand zone, and right now all we're doing is starting to create a consolidation zone at this intraday price point of interest. Even if GJ comes to 160.5, I'm still looking for buys. Breaks back above 161, breaks above 161.2 and 161.5, I'm still looking for GJ buys. Playing the higher time frame bullish structure, intraday bullish structure, Japanese yen weakness, and of course confidence in the UK equity markets, and a lot of the fear, uncertainty, and doubt being priced in. The only thing is, right now, volume and volatility is a bit lower and slower, as of course we're just starting out the new quarter and new monthly period. So you have to keep an eye out on the current volume and volatility. But I'm bullish on GJ. I would only sell GJ below 159.5 is the only way I'd switch into a sell side bias. Okay, so it makes sense playing the yen weakness. It makes sense, of course, with the volatility index being bearish, but on our dollar pairs, we can see the dollar's a lot more bullish. Because the US dollar is the global world reserve currency and a safe haven currency in itself, but not just that, the primary global business currency, it holds a lot of weight on an international scale. No matter usually what's going on fundamentally, in pairs like GU and EURUSD, AUDUSD, NZDUSD, it's going to be inverse movement of dollar index. Fundamentally, for that reason stated, because the dollar index still holds that weight as the global world reserve business currency, right? Most international trade from an institutional perspective is still done in dollar denomination. Does that make sense for everybody? So this structure you see on dollar, with buyers printing highs, having pullback or consolidation phases and continuations back up, when you look at the broad structure on GU or EURUSD, it's going to be the inverse, right? It's the inverse. You're having sellers printing lows and driving back down to those lows and so forth. So right now, what we're seeing is we're just consolidating at the lows and very messy price action. For me to see impulsive dollar strength come back into play, we're going to need to see technical breaks on the dollar above 99.5. If dollar breaks above 99.5, this is going to be very, very easy sells on GU and EURUSD with that correlation, and the technical price points of interest, I'll tell you individually on those pairs in a second. But just because we reach to the top of a range technically doesn't mean we always break. If we don't have any volume to break, we could still end up consolidating. As manual retail traders, we don't know if we're going to consolidate for a day, a week, a month. We just use our technical analysis alongside our fundamentals to make potential projections and then, of course, adapt accordingly, right? So that's how we adapt. If we get technical breaks above here, that's easy signals for us to know, hey, dollar buyers are in the scene. Dollar buyer volume is strong. I'm going to go look for GU sells. I'm going to go look for EURUSD sells. I'm going to potentially look for UCAD buys. But we can't guess that until we actually have that break above, right? For example, you can see here, this consolidation zone before we finally had a break to the upside lasted the entire month of like October into November. This consolidation zone lasted almost a month and a half, and we actually ended up doing a deeper pullback before continuing higher. Right? So we can't just hope and guess we're going to break out. We've been playing this short-term strength in the dollar from the bounce of the demand zone lows and consolidation zone lows as we retested roughly previous highs. But for us to see any more dollar strength and validate that dollar strength, we really need breaks on the dollar above 99, 99.3. Does that make sense for everybody? If dollar doesn't technically break above there, it will just continue to range and consolidate, especially as we're very early into the new quarter, early into the new monthly period, and a lot of the fundamentals have been priced in. No, this economic calendar is a $20,000 terminal, Reuters icon, for news, headlines, and everything else. It's not from TradingView. The guy who's scalping gold right now in the chat is probably just some random retard. Don't pay attention to him. He probably has zero consistency. Trust me on that one. I'm well experienced in this. Met thousands of traders in my life. Hyenas don't last long in this game. They're just gamblers. You know what I mean? Okay, so with that being said, we can see that our dollar pair is in a very specific range. So we're just going to keep it very, very simple here on dollar pairs. Okay? Don't touch this range. 1.309 to 1.313. Do not touch this range. Okay? Only play some sells if dollar breaks above those highs and we have technical breaks above 309. Dixie strength break highs. GU break low range. Trying to make it as easy to understand as possible. GU break below 1.309. No touch range. No touch trade zone. Okay? This is too much of a guessing game here. Look at all this indecision, the wicks, the indecisive candle bodies, both similar size, bullish and bearish, not any significant like buyers or sellers strength. Big guessing game in this range. All right? And to keep it very simple, only play some of the buys if dollar fails to break the range. Okay? Now, same ideas are going to be on EURUSD as well. Listen, you know I'd love to give you guys one-sided bias. I love to give you guys as much information as possible. But as we're starting the new quarter, as dollars ranging, right? As dollars ranging, as of course we have lower volume and volatility, I don't want to just give you guys a random trade based on a guess and then fuck people over. A lot of people depend on my analysis. They reference it with their own. They follow the trade ideas. If I don't see something clean, I'm going to be honest and tell you guys. I'm not just going to say something for content or just say something for the webinar. You know what I mean? And right now, US dollar pairs are just ranging as the dollar index is ranging and we're sitting at these significant lows. So it's best just to play it smart. Either stay out of the dollar, don't touch this range, or wait for dollar strength, break below the range, break below 1.309 sells, or the inverse here. Okay? I'm just being honest with you guys and straight up. EURUSD though is showing us a bit more seller's pressure. But for me to see further sells on EURUSD, pull back to 1.0 and break back below 985, sells below 1.093. EURUSD individually is a lot more bearish. So you can see as we're having these highs printed, we're showing a lot more seller's pressure with potential to revisit these lows as ECB's been a lot more neutral and any of their hawkish tone has been faded out. I'm also expecting weaker Euro economic data. I would only take buys on EURUSD above 1.104 with dollar weakness and strong Euro data. USDCAD, very, very messy range. Okay, same idea on USDCAD. This is on the hourly chart, but you can see the range more defined here on the 4-hour chart as well. Same thing as GU. This is a no touch zone. Very messy intraday price action. You have very aggressive wicks, failures to break previous highs and lows, indecisive candle bodies not signaling buyers in control or sellers in control, the same time dollars ranging. Only take sells below the low if dollar is weak and oil strength comes back into play at 246 with very safe sells, dollar weakness, failing to break those highs, oil strength with the Canadian dollar holding the bulls individually, break below 246. There's no point playing guessing games here. Sure, if you want to scalp it, maybe 10, 15, 20 pips, no problem. But with my 5 years of experience, what I have noticed is that the majority of people will be great when they're trading trending markets, but then they'll waste so much time fighting ranging markets. They'll give all their profit back. They'll overtrade in ranging markets. They'll be going back and forth between buys and sells. They'll be fighting the market as it's doing heavy pullbacks on the lower time frame, and they just exert their mental energy. They lose all sense of risk management. They're changing their bias back and forth between buy and sell. They burn all their profit, and then when the breakout happens, they're sitting on the sidelines and wondering, oh wow, the market fucked me over first. Fucking market destroyed my account first. You know what I mean? So timing the markets and knowing when to attack, when to sit on your hands is very, very important. Okay? Understand that. Last but not least, US 30 stock market exchange. Still expecting higher time frame bulls. Inflation is still high. Investor and smart money market maker greed is still extremely high. We have potential intraday high targets of 35,400. Pull back to 34,600. Break above 35K. Break above 35,200. Main bias is buys. Equity markets are optimistic. Fear, uncertainty, and doubt with Russia tensions priced in, interest rate hikes priced in, global equity markets bullish, bullish price action and market structure. I would only switch to a sell bias if we get new fear events, meaning NATO allies want to get involved with a military standpoint and the US starts to send their military to Russia, and then new fear with breaks below 34,300. That's the only way. Okay? So anyways, everybody, we went through key fundamental points in focus regarding fundamental catalysts, market timing, and so forth. We understand the market sentiment impact and did some individual analysis on the dollar, Japanese yen, and equity markets. We understand and did a reading of volume and volatility with the movement we've seen so far to start the week, also referencing the fundamental catalysts at play. We went through any key notable headlines through the New York session. That's just anything of interest, informational, or relevant to the markets as well. We went through what economic events we have on the docket and what's on our focus overnight and tomorrow. And I gave you fundamental and technical analysis as well as trade ideas on gold, GJ, GBPUSD, EURUSD, USDCAD, and US30. Hopefully, if you guys enjoy these webinars, please do me a favor and send a like, send a comment on the saved webinar. Check out the description for all of your free resources. You have the Capital Hungry YouTube page with all these playlists, educational content, better than any marketer, better than any guru on IG. You have the Telegram analysis channel, Capital Hungry News Twitter. Okay? I don't know what this guy's thanking me for, but he caught 10 pips and said he's done for the week. I don't know, weird mans. Please read the description, send a like, subscribe, and I'll see all of you on Wednesday for the scalping session in the morning. I'm either going to host it and do one myself, or I'm going to be a guest on Raja's stream. All right, everybody? Thank you. Have a great evening. Have a great night. Take care. I hope you guys learn a lot. I don't know. Hope you guys have a great night. Be smart. Don't forget also, last thing, all of us are manual retail traders. Follow your trading plan, follow your risk management plan, focus on long-term vision, keep emotions out, and avoid crashing your account.